Hello, everyone. Chris Hatley here from Fairway Independent Mortgage. There's a lot of buzz out there about mortgage rates and the changes the government has made to how mortgage rates are calculated based on credit scores. And I wanted to make a short video to make sure you had the facts and dispel a little bit of the misinformation that's being thrown around out there. First, let me give you a quick history lesson on what loan level price adjustments actually are and what's causing all this controversy. So, loan level price adjustments were introduced in 2008 by the newly created Federal Housing Finance Agency. They were put in place to offset the risk borne by Fannie Mae and Freddie Mac, who were going through a rough time during the mortgage crisis going on back in 2008. So they only affect conventional loans that are sold to Fannie Mae or Freddie Mac. They don't affect any FHA, VA, or USDA loans. Then in August of 2020, the government started a 50 basis point adjustment to all refinance loans, which they called an adverse market fee, which I find a little funny because it was a great market and they were, I think they saw an opportunity to make some money on refinances, so they took it during the boom. But then in January of 2022, the LLPAs for second homes and high balance loans was introduced. For second homes, this additional cost was between 1.125% and 4.125%. So if you're doing a loan on a second home at $200,000, this increase in cost is between almost $2,300 to almost $8,300. That's a huge difference. So that brings us to today, where they have totally revamped the LLPAs again to the point where it is downright, frankly, very difficult to understand and explain. We actually need a computer program to actually price mortgage loans today. That's how complex it is. But if you look at this first grid, you'll see the adjustment that the government charges borrowers at different loan to values and credit scores and a bunch of other factors. So this goes into effect today. And if you look at this second grid, you'll see the amount of the change on the new grid as it compares to the adjustments on the old grid that were made before today. So as you can see, one of the big factors here, one of the big adjustments is that the higher credit score borrowers have their adjustments have risen in some instances, where the adjustment for the lower credit score borrowers has gone down in almost every instance. Now, this is where the controversy comes into play and where people get a little upset. And it is justifiable, because if you're locking a loan today, you're getting a mortgage today, and you have a 780 credit score and all the other variables remain the same, you should expect to pay about a quarter to a 0.375 higher interest rate than before this change. Now, what I want to make clear, though, is that if you have a 780 credit score and you're comparing that to someone who has a 640 credit score, assuming all the other variables are the same, you will still get a lower rate than if you had a 640 credit score. So what's the moral of the story here? Don't tank your credit score thinking you're going to get a better interest rate. That just simply is not true. And there's so many other variables that come into play as it pertains to the credit score. And there's ramifications to that that you really don't want to play that game, because you frankly may not get a loan at all if you have a low credit score, because we look at not just the credit score, we look at credit history, we look at all kinds of things. And the second thing that'll have the lower credit score will have a huge impact on is if you're not putting 20% down and you need PMI. If you have a 640 credit score versus a 780 credit score, your PMI premium could be 3, sometimes 4 times higher than if you had the 780 credit score. So don't tank your credit score. And if you have any questions about this or any other mortgage stuff, I'm here to help. Feel free to call me at 717-730-4476 or my cell, 717-571-6384. Have a great day.